All right, welcome to the REI Club at Intel. This is a club where we hear from educational speakers on real estate topics throughout the United States. Today we have Carrick Sears, and actually, you're going to have to introduce yourself as well, Royden.
Yeah, hi, I'm Royden. I'm working at under Carrick here at SVN. So
Okay.
Tag along.
Great. And let me see. Next week, we also have Derek Clifford on growing a single-family home portfolio, Jen Katzov and Ganga Tawardi, who are going to be talking about triple net leasing industrial space. Lean Harris, she is an interesting person. She travels around the United States actually doing seminars and lectures on short-term rentals. And she's got quite a short-term rental portfolio, and she teaches other people to build a short-term rental portfolio. And then after that, I'm looking forward to Anne REI mom Kelly, who's prolific on social media, and she's an avid investor as well. I saw her URL, reimom.com, and I thought, ooh, I wonder if reidad.com is available. And so I actually went out and got that URL. It was available. Hopefully one day I'll do something with it, REI Dad. But those are our upcoming speakers, and we actually have a few more that are scheduled that just aren't on our meetup.com site yet. And remember, if you need to find previous speakers, go to our SharePoint site that's here. If you need to subscribe or unsubscribe, there's a quick video that'll show you how to do that here. I highly recommend that you subscribe. Otherwise, we have to send out direct email notifications, and I'd like to reduce that as much as possible. But if you do come to the SharePoint here, make sure you visit the previous speakers page. I've had a couple of people ask me recently, how do we find videos and slides from people who have previously spoken? And all you need to do is go here to the previous speakers page, come down and find a person. Let's say you want to find, a lot of people were asking for Mark Perlberg because he gave a really good talk about reducing your taxes. Just come over to his page here, click on him. You can find his name, his website, his email address, the URL to a recording of his presentation, and a URL to a PDF of his slide deck. So you can just grab that, paste it in your browser, and up comes his slide deck. So make sure to check that out. Most of our speakers have those things here. And with that, we'll turn it over to our guest speakers for this week, Carrick and Reyen. Hey guys, could you introduce yourselves and say hello to the Intel REI Club?
Absolutely. All right, is the presentation up there now?
It is.
Okay, great. My name is Carrick Sears. I am a multifamily broker here in Phoenix, Arizona. I have my MBA from the Thunderbird School of Global Management and my CCIM as well, which is a certified commercial investment member. And my background before I got into commercial real estate was in financial analysis. So my specialty is helping people buy and sell commercial real estate, in particular multifamily, and really to focus on the numbers. I love to get into Excel and help people to maximize their ROI. And what comes down to a good investment is truly about the numbers. And Royden?
Hi, everybody. I'm Royden Hudnall. I'm here working under Carrick Sears as a multifamily broker. I graduated Colorado State in May of 2020, and it's been a pleasure working under Carrick, and I'm happy to present to you guys today.
Great.
Just so you guys know, usually we have all the people put their questions inside the chat room, and then when appropriate, I'll judiciously interrupt you and ask questions. Either that, or we could hold them all to the end. Your choice.
Yeah, we can do questions as we go along. It's probably most pertinent to cover them up when we're as we go along.
Okay,
yep,
sounds good.
That should be fine. All right. So this afternoon, we want to talk to you and give you a little update on our Phoenix market update, so you have a better idea of what's going on in Phoenix, Arizona, if you're not here, and even for those who are in Phoenix to know a little bit more about our market. Royden stayed up late last night crunching our latest numbers on Q3. So we have some good multifamily statistics that's through the third quarter, hot off the press. No one else has even seen these yet. They will go out in our newsletter, but right now they're fresh off the press. We're going to talk about some ways to exit a property. So one of the important things in real estate is when you get into a property, how do you get out of it? It's good to have an exit plan in mind before you even buy something. So we want to talk about that. We're going to give you a few tips on remodeling, talk about a rent increase matrix and how to look at rent increases, and then cover cost segregation and some of the great tax benefits that doing a cost segregation study has.
Now, I know one question that's going to come up is that quite a number of the people in this group are also single-family home investors. And how closely do the rents or do the statistics that you're going to be given correlate to that segment of the market as well? I know, just keep that in the back of your mind as you're going through.
Yeah, I will say when we talk about our rents for multifamily, it's very correlated to single-family home rentals as well. So we're seeing the same kind of rent increases, same kind of occupancy and vacancy in single family as we are in multifamily. It's very closely related. And so this is our multifamily dashboard report that we put out once a quarter. There's our contact info there on the screen. We'll also give it again at the end. If you'd like to get on our email distribution list for our quarterly multifamily dashboard, please reach out to us and we'll be happy to make sure you get that. Our November dashboard report will be coming out in the next couple of weeks. So without further ado, I'll turn it over to Royden, who will talk about our latest Q3 numbers.
Hi, everybody. So today I'm going to go over.
You're so timely.
Sorry, what'd you say? So everybody,
I'm going to go through and try and mute people.
Oh, okay. So I'm going over some statistics about the Phoenix Metro real estate market. This chart breaks down market sales statistics of the entire Phoenix Metro into different asset classes. So we're seeing a lot of deal volume for both smaller and larger apartment complexes. Phoenix has seen a 160% sales volume increase in smaller apartments and an astounding 208% increase in the deal velocity for larger apartments, 100 units and larger. For buildings that are 10 to 99 units, the average price per unit has increased 65% from just 1 year ago, and the average price per unit of the smaller apartment complexes are $225,000 per unit. For buildings with over 100 units, the average price per unit is about $278,000, which is a 48% increase from a year ago. And I want to mention that these stats are being inflated by the high amount of high-class apartments being constructed and then sold after they're constructed, but these are the averages of everything in Phoenix Metro. So here we can see the year-over-year stats of Phoenix Metro's rents. As you can see, all asset classes rents have increased over 14% in the last year, with discretionary, upper mid-range, and low mid-range asset classes increasing over 20%. The average apartment rents for an astounding $298 more than it did just 1 year ago, which is a 24% increase value-wide.
That is a super hot market.
Yeah, it's an incredibly hot market right now. So this chart breaks down each submarket in the Phoenix Metro and gives averages of the entire Phoenix Metro. So this table has a lot of information, but here are some highlights. Phoenix has a 5.4% vacancy rate, which is extremely low. For example, if a 1-unit apartment complex is empty for 1 month out of the year, it has an 8% vacancy rate. The average apartment rents at about $1,542, which is over a 21% annual growth. And if you wanted to buy an apartment complex, you would have to pay $245,000 per unit. As I mentioned earlier, this is being inflated by the high amount of high-class apartments being constructed and then sold, but these are just averages of everything that's going on in the valley. Okay, so in this chart, we can see net absorption versus deliveries. So deliveries are how many units are being constructed and added to the market. Net absorption is how many of those apartments are getting rented out. As you can see, we have a very healthy ratio, especially if you compare it to the Great Recession, where there was negative absorption. So we have a very healthy market here in Phoenix, and we're excited to continue to watch it grow. Okay, so on this chart, we can see some multifamily price and cap rate trends. A cap rate is your net operating income divided by your purchase price. So if you had $1 million property that generated $50,000 of net income per year, this is your income with expenses subtracted out. That is a 5% cap rate. conceptually, a cap rate tells you what percentage of your purchase price you will generate from the property yearly. The lower the cap rate, the more expensive the property. And as you can see from this chart, cap rates have plummeted and prices have increased dramatically. And as I mentioned, I just have to say it again, this is due to the high amount of high-class apartments being constructed and then sold to overpaying investors. Now, this graph, oh, sorry, that was the cap rate slide. I apologize, I went a little bit quicker. Here, you can see the rental rates for apartments and the vacancy rate for those apartments. So you can see that rental rates are increasing dramatically, and at the same time, vacancy rates are declining. Apartments are filling up their vacant units in a short period of time at higher prices. So we're in a crazy market here in Phoenix, but we do have some healthy fundamentals that will allow it to continue to increase and hopefully do well, at least for the near future. So with that, I'm going to pass it on to Carrick.
Yeah, absolutely. One of the nice things about Phoenix is we have very strong population growth. We have 244 people that are moving here every day. And so the population growth, along with the job growth that we have experienced, the income growth, we don't see the party slowing down anytime soon. We're definitely seeing another strong 12 to 36 months of continued very strong growth. As you know, despite what the nation does as a whole, each geographic area is a little different. And here we have a very well diversified economy, and we continue to know that we're very underbuilt. Even with the 10,000 units that are currently under construction here in our market, we know we are still underbuilt with all of the population that continues to move to the Sun Belt states. So we definitely get a lot of people asking, what my property's appreciated, what should I do? And so these are 4 options we kind of wanted to highlight for you to give you an idea of what you can do if your property has appreciated and you're interested in exiting the market. Certainly, the market is high right now, prices are high. It could be a good time to sell. It could be a good time to diversify, to look at your portfolio and kind of readjust yourself for the future. And so that's what we do. We help people buy and sell apartments, and we also offer consulting and advisory services as well. So option 1 would be don't sell, keep it. Option 2 is a 1031 exchange. Option 3 is what we call a deferred sales trust. And that's what we wanted to share a little bit about with you today. We have a referral partner that handles this, and we've had some clients be very happy with it. Option 4 would be to actually sell and pay the tax. One of the benefits about a deferred sales trust is it's not very well known at all, and so it's one of those things that is allowed with the IRS, but not very many people know about it. It's good to mention it to your CPA, see if they know about it, and if not, we definitely hold a lot of conference calls with CPAs and clients to get everybody on the same page and educate and see if it's a good fit for you. But basically, the way it works is it's kind of like a 1031 exchange in a way, where the trustee of the trust that is set up will work on your behalf, and they will actually sell the asset to a buyer after you transfer the asset into the trust. And then that money that the buyer pays for your property goes back into the trust. And so the important thing is that you do not take constructive receipts of those sales proceeds. They stay in the trust, much like a 1031 exchange. The nice thing is you don't have a 45-day identification window and a 180-day window that you have to go and replace your property. And so you can choose to reinvest in real estate if you want without a time limitation. The trust is set up for a period of 10 years, and it can be renewed. And if you think prices are high today and they might come down in the future, you can go ahead and invest those funds into stocks, bonds, mutual funds, things like that. And then you can go and purchase real estate down the road when you want to. And so that's a nice thing about a deferred sales trust, is it allows you to reinvest in real estate.
Yeah, that's my phone number. I was thinking I was writing down the number that was called.
Hi there. We're getting somebody on the line.
Just need to mute out them, I think. All right. So that's the overview there. And so is there a minimum transaction size for a deferred sales trust? A general rule of thumb is about 250,000 worth of capital gains for a deferred sales trust to make sense. And if this is something you might be interested in, let us know. We'll be happy to sit down with you and see if it might be a good fit for you. But it works by the IRS code of installment sales. And that's essentially the methodology behind it. So it works for a business, it works for commercial real estate, investment properties, single family homes. It also works for stock. So we've had employees in Silicon Valley who will transfer in their stock and their options, and then the trust can sell the stock and not have a capital gain taxes that have to be paid. So it's really great if you have stock options and things like that, which you're considered liquidating. Here's a way to do it without having to pay taxes on them. Great tool. So we definitely have a lot of people looking to buy, and it's getting harder and harder to find the perfect apartments, such as the unicorn apartments. There, with the market so hot, we have so many people looking for great value add opportunities. It really is hard to find. They're getting far and fewer between because a lot of the ugly dogs have now been remodeled, but they're out there, and that's what we help clients do is find the right property for them. There certainly are still some good opportunities out there, and we also think it's still a good time to buy because the market is strong and we just don't have enough places for people to live. And so we think buying the right property is still possible, and there are still good opportunities that make sense. And so we definitely think it's still a good time to buy. Alternatively, if you don't want to be active in the real estate market and actively managing a property, another option is to consider passive investing opportunities. We have developers that put together projects, and they'll give preferred return on the equity 8, 10, 12%, with projected overall profit sharing on the development opportunity as they build new apartments, and give over a 30% return in most cases. That's what we see. So those are other options to consider as well if you don't want to be actively in the management business and running your own investment by yourself.
We've got a number of questions around the DSTs. Should I
Sure.
jump in here and do that?
Sure.
All right. So the first one is who and when do you pay the tax for a DST?
Yes, great question. So the tax is never paid until you withdraw money out of the trust. So let's say you buy some apartments, they're making a healthy income. You could say you want to retire, you're no longer working at Intel, and you want to start withdrawing some money from your trust at retirement. You can do that. And so if you take out $10,000 a month, $20,000 a month, you would pay taxes on the portion that you take out as you take it out.
Okay. And we have another question about, can you speak more about transferring stock into a DST and how capital gains are avoided?
Yes, so similar to real estate, the trust would be set up, and the trustee you would transfer the stock from your own holding account into this new trust that's set up. And then once the stock is in the trust, the trustee can sell the stock on your behalf. They'll have the funds available in dollars in the trust, and then you can go out and you can buy real estate with it. You could buy other stocks, bonds, mutual funds if you're not ready to buy real estate, but when you are, you can buy real estate with that money, and it's not taxed until you take the money out of the trust. And I'm not an attorney and I'm not a CPA, and so what we recommend, if you're interested in this, to get in touch with us, and we actually schedule a conference call with these experts who will help walk you through it and see if it's a good fit for you, and even involve your CPA in this, so we really make sure it's the right opportunity for you.
All right, this does seem to be a popular topic, but quite a few of the questions are getting into operating DSTs, and I know you guys don't do that. But there is a question here: what's the cost to establish a DST, and what are the annual operating costs?
Right.
I was going to say, I think that might reveal a misunderstanding that we're not establishing DSTs. These are already pre-existing DSTs, right? That people are buying into.
No, so this is different than a Delaware statutory trust. So a Delaware statutory trust is where you might be one of 100 investors going in to buy a big hotel or a big apartment building. The Deferred Sales Trust, which also is DST, nothing to do with Delaware. this is your own 100% your trust, 100% controlled by you along with a trustee that you hire to manage it for you. It's your ship and you're running the show. And so, we'll dive into this more if you're interested and give you an individual presentation. And I will say that the fees are small. We're talking 2 to 4% to have this set up with your assets.
Okay.
We'll get back here. So we wanted to give you guys a few remodeling tips. If you're into value add opportunities and you own apartments and you're always looking for what's the latest and greatest things that you can consider doing, wanted to give you a few ideas. So the most important is to know your target tenant. Will they pay extra rent for stainless, for granite, things like that? Sometimes we have clients who think they'll add a pool into their property, and you have to ask yourselves, are your tenants going to pay another $100 a month just to have a pool? And usually the answer is no. So there are some things when we see tenants when we see landlords over improve their properties as though they were going to live in it themselves. And so it's just really important to remember, you're not living in it. It's for the tenants. Who's your target demographic, and what will they appreciate, and what will they pay more for? So pet doors is a popular item that's come up. We're starting to see those put into units that have a little patio where the dog can go outside and come inside the house. The fact is, I think about 75% of households have a pet. And so it's good to if you can, embrace the pets and let them come, because it certainly opens you up to a lot more tenants, and they'll pay more. They'll pay more money. And if they have a pet door built into their patio, it's just something that's appreciated. LED lights. If you're paying electricity, very important to try to lower your electric bill and have LED lights. Water saving toilets. 99% of our landlords are paying the water bill. And so having water saving toilets, shower heads, faucets, those are very important. We're going to go into that a little more. In-unit laundry is also a really nice feature. A lot of our clients consider one of their top value add items they do is to add a washer and a dryer into the unit, so people don't have to go to a laundry room to do their laundry. Some nice amenities can be having a dog park area, even a dog washing area where you would have a hose and some people can wash their dog outside. Trash concierge, that's seen in larger properties and generally Class A properties, but it's where a trash concierge comes around at nighttime and picks up the trash that's left out by your front door. And it's a nice amenity to offer tenants. It's popular, and it always keeps the place a little neater and tidier anyway as well. Offering coffee in the lobby or rental office. If you have a employee who's a tenant who's going to get coffee every day, that's $4 a day, let's say, to go to Starbucks times 20 days, $80 a month. I mean, you could offer that for a fraction of that price and get more in rent, because you're offering a convenience to your tenant. But besides just the financial aspect of it, it also saves them a lot of time if you have something like that available. Package delivery, oftentimes people can get packages delivered to the lobby and accepted on your behalf. Cornhole, nice little popular game to offer tenants in a lawn area. And then resort style furniture. I can't tell you how many times we tour Class C apartments and see awful, ugly lawn furniture out by the pool, umbrellas that are old. So, tenants these days, they want to be able to have a luxury pool area if you have it. And even if you don't have a pool, have a nice barbecue area, a gazebo where people can barbecue and have nice furniture. A little bit on water saving toilets. We definitely recommend installing some of these items because it really reduces your water usage and your utility bills by 30 to 60%. There's different companies out there that have water saving devices. The Niagara Stealth toilet is 0.8 gallons per flush, which is incredibly efficient. And so that's the one that we've seen apartment communities start to install. And it really does add up when you start to look at the savings you can generate. It has an instant payback on doing a toilet, doing a shower valve, doing faucets. It's an amazing ROI. And so it's one of those things that's good to consider, that not everybody takes this into consideration, but it's one of those things that you can just to be a little more efficient with. Some of the top water consumption devices are the toilet, the shower, and the faucets. And so if we can conserve water there, that's going to be more money in your pocket and more profit at the end of the day. These are a couple of case studies where they went in and replaced the toilets, the shower heads, and the aerators for the sink faucets. And as you can see, say, depending on the size of the property, a lot of savings and then a lot of asset value boost based on doing that investment. All right, one of the things we want to show you is a rent increase matrix. So we get a lot of questions on, how much should I raise my rents when I remodel them? And then what do I do with my units that I don't remodel? And is it worth remodeling? Do I kick a tenant out to remodel them to raise the rents? And so we wanted to walk you through a little analysis that takes maybe a different approach than what you're used to. And so let's say your classic base rent on an apartment is $1,000 a month. And you're thinking when you do a remodel, you can charge $1,100, which is a $100 increase. So a $100 increase over 12 months would be $1,200 additional income. And if you divide that by the cost of remodel, let's say it's a $6,000 remodel, that's a 20% ROI. And that's usually a very popular hurdle rate that investors like to see is a 20% return on value add improvements that are made. And so having said that, if you value your property at a 5% cap rate, that increases the value by $24,000. And that's basically $6,000 divided by 0.05. That's $24,000. And so by spending $6,000 out of your pocket, you've increased the value of your property by $24,000. That's an $18,000 gain in your asset value. And so let's say, maybe you want to say, well, what should I do with my apartments that I don't remodel? Should I increase their rent as well or keep them the same? And so I always say it's good to know your break-even point, because essentially that tenant that stays in an unremodeled unit, if you give them a little bit of a rent increase, they're not going to move. And then if you give them too much of a rent increase, they'll move. And so you want to know, like, at what point are you okay pushing the envelope too far where they move out and then you have to remodel the unit? And so I like to look at it to see, at what point you're comfortable. If they don't like your rent increase, they just move out. And so let's say you did a $75 rent increase for somebody that is on an unremodeled unit, and using the same ROI, that would be, it would increase your value by $18,000 without spending any money on the property at all. And so for some, they might say, okay, you know what, I'm going to charge $1,075 on an unremodeled unit. But let's say your time to actually turn a unit is worth something. And so if you figure out, you might even have some fees in doing it for a commission to a leasing agent. You might lose 1 month of rent, perhaps in turning a unit, of course. It takes some time to remodel a unit. So if you value that a little bit, you can see that, maybe a $64 increase for that unremodeled unit might be a little more appropriate. And that's basically taking a what do we have there? $2,500 worth of fees, and saying if a turning a unit costs you about a $2,500 worth of time and commissions and lost rent, then really increasing that classic unremodeled unit to $1,064 would still get you a value add increase of $15,000 without doing any work. So it's what we're doing here is pushing the envelope where you're going to increase your rents more than you might have otherwise on an unremodeled unit, to the point where if the tenant decided to move out, you're okay with it because you can spend that $6,000 to remodel the unit and get your value add by increasing your value. So that's what I just wanted to show you is a lot of people are don't necessarily think of it this way. And so it's just another way to think of that and do the math and see what it's worth to actually raise your rent to the point where the tenant would move out and you'd be okay with it because you know that you're going to come out ahead. So this view here shows that if your team's time is worth $3,000 and then you have fees of $1,000 and lost rent of, let's say, 2 months at $2,000, you add that up. What you want to do is just increase your classic unremodeled rent to $1,050 is a conservative approach and still add $12,000 worth of value to your property. So I like to share this to people because sometimes people think of, in our market in Phoenix, $100 raise for a remodeled unit and keeping that, but I'm challenging people to raise their classic unit still another $50 by doing nothing. The tenant's not going to move out, and you'll still increase the value of your property. And so it just helps you look at it in a little different way when you do the math that way. So the other thing we want to talk to you about today, give you a little bit of tips on saving money from taxes, is what we call cost segregation. And cost segregation is a very useful tool that most well-educated, well-to-do professional real estate investors do. Some of the smaller and medium real estate investors that we work with had not heard of cost segregation before, and so we like to bring this up to everyone so that everyone has the opportunity to take advantage of tools that are available to them in the IRS guidelines. And so what cost segregation is it jumps up the normal depreciation. So the IRS normal guidelines are that if you buy an apartment building, 27 and a half years is your depreciation schedule. On a commercial building, it's 39 years. And so it's every year, essentially, on an apartment building, you're taking 1/27th of your asset and depreciating it as an expense. But cost segregation allows you to step that up and accelerate the depreciation based on breaking the different components of the building down into different categories based on their useful life. And so it's not a tax loophole, it's really smart tax planning. And the IRS says that it's desirable for taxpayers to maximize this and accelerate their depreciation in the way that's legal. And so it's just to take truly advantage of what's available. If the property can be, yes.
Oh, really quickly, there is a window right there. You've got your mouse on it right now. Can you move that out of the way? It's distracting some people.
There's a window, a little window.
Yeah, that gray, it's probably not gray to you, but it might be a Microsoft Teams window, maybe a profile picture.
Okay, is that out the way now?
That's probably good.
Okay, yeah.
Thank you.
So if the property can be removed without damage to the building structure, then it is considered personal property. So this is things like carpets, countertops, window coverings. And so those are the things that can be more rapidly accelerated with a depreciation schedule. And so the things that are going to still have a normal depreciation are your real property. Those are the things on the left there that you see. That's going to have a 27.5-year depreciation schedule for apartments. Our land improvements there in the middle, those are going to be things that we can depreciate in 15 years. And then on the right, those are personal property. These are the things that we're definitely working on replacing when we're remodeling. They just don't last 27 years, right? And so the IRS allows you to accelerate those on a 5 or 7 year schedule. But you have to have a cost segregation study. So you need it's a third party that specializes in this, and the IRS, if you want to do an accelerated depreciation and you get audited, they're going to ask for the proof that what you did was correct. And so you want a third party to come in and break everything down into the categories for you. And so it's audit defensible is what we're looking for here. And so on apartment buildings, our typical reclassification is about 35%. So a good third of the purchase price can actually be reclassified and accelerated into a depreciation model that's not the normal one. So let's take an example here. Here's a $1.2 million assisted living home. And the things that are going to be reclassified into the 5-year assets are those kinds of things there that you see that we know just don't last 27 years. Here's some additional things that also the IRS says don't last 27 years, and those can be put on a 15-year depreciation schedule. So when we do this, a normal depreciation for this assisted living home would be $43,000 a year is what can be written off as depreciation and expensed. But with a cost segregation study, we can put a chunk of those assets types into 5-year, 7-year, and 15-year columns, as you see there. And so essentially, at the end of the day, it's an additional $49,000, which is the present value of those tax savings. When we add up years 1 through 5, the tax savings come to $70,000, and that's by creating an additional $196,000 of depreciation. And so we look at things, the present value with time value of money. By having all those tax savings up front in the year that you do the study, it would be a $49,000 effective savings. And so for existing properties that you already own, this can apply. The IRS does allow you to do a catch up on missed depreciation. So if you bought a property 2 or 3 years ago and you're just hearing about cost segregation today, it's not too late. There's still time to do it. And the nice thing is, when this is an example of 5 years after somebody bought a property, they're getting increased depreciation of $203,000 in the year the study is done, and the tax savings of $81,000. And so you don't have to do an amended return. You just do it in the next year. You file your taxes by next April. You put into your taxes your new accelerated depreciation schedule, and your CPA can do a catch up on that depreciation. So it's good to get an analysis done. We have a company we work with that does these, and so if this is something that you think might be beneficial to you, let us know. We're happy to help. If you currently own an income property, you can catch up. If you're buying a new property, it's a great time to get it done right after you make the purchase. If you're going to do a lot of renovating or remodeling, also can be good to do it. And most importantly, it needs to be done either before you sell the property, which is ideal. But if you just sold a property, let's say this year, the most important thing is to do this cost segregation study before you file your taxes next year. As long as it's done before you file your taxes on the property where you're going to claim that asset sale, you're okay. You can still take advantage of this.
Hey, Carrick, do you recommend a cost segregation study for a small multifamily or even, a single family or short-term rental?
Yes, I have personally done this for every property I own, whether it's a single family home that's a vacation rental, a long-term rental. I've done it on fourplexes I own, apartments I own. So any kind of income producing property, it's other than land, which has no depreciation basis, anything which has a structure on it. It could be an industrial, retail, office, any kind of building on a property is depreciable, and you can take advantage of this. And so sometimes we could ask, are you going to have to pay it all back when you sell? Is it just a money game? And it's not. Like, there certainly is a time value of money. If you get a tax benefit now, you don't have to pay your recapture taxes till when you sell. But keep in mind, in addition to the time value of money, when you do have to pay some taxes back on the recapture taxes when you sell, it's at a lower rate. So these deductions are going to help your ordinary income tax, which let's say it's in the 40% bracket with state and federal. The recapture tax is at 25%. So you're definitely going to save on that. And most importantly, you're going to reduce and eliminate a lot of taxes. So on the 5-year assets, let's say your carpets and your flooring and some of those things that we said are the 5-year assets. If you keep your property all of the 5 years, when you go to sell it, you're not going to have any recapture tax on the 5-year portion of your asset. It's going to be written off and expensed completely. So that's why cost segregation is so awesome, especially for properties that have a lot of individual furnishings and fixtures and things in there. Apartments and hotels are the ideal candidate for it, but this works well for office buildings, retail buildings, industrial, all of that. And so here's an example of a property an apartment building that was purchased for $2.5 million, sold for $3.3 million, and that has the land value taken out. So we're just dealing with the actual value of the building that's vertically built on the property. Without cost segregation, this person would have to pay a total of $285,000 in taxes. But with cost segregation, they are just going to pay $203,000 in taxes. And this, of course, is assuming that they don't do a 1031 exchange, right? They're actually paying the taxes. And if you do a 1031 exchange, this is still beneficial because you're creating expenses that's going to offset your income. So it still has benefit even with a 1031 exchange. So the IRS allows you to expense the remaining basis of a building. So you're not going to have to pay taxes on parts of the asset that are no longer in service. So one of the reasons why cost segregation is good is if you do remodel a property and you throw away a lot of the things in the unit, you're filling up a dumpster outside your property as you remodel, those things, you can have your CPA take them off of your cost segregation study and fully expense them because you literally just threw them in the dumpster. And so that's another nice benefit is when you have this study done, if you take off a roof and you put on a new roof, you can expense that old roof completely. Air conditioners, flooring, old cabinets, old toilets, old lighting fixtures, things like that. So this gets even better. Yeah.
Oh, we had a question about what a ballpark estimate would be for how much a cost segregation study would cost.
Yes.
And I know that varies by the size of the property, but maybe you could throw out some numbers that are approximate.
Yeah, so for a single family home, we are usually, it's usually in the 2,000 to 2,500 range. As we get into a fourplex, we might be in the $3,000 to $4,000 range at most. And then as we get into larger apartment buildings, 5 to 10,000 is usually where most of our clients are at. But yeah, even for a single family home, not more than 2,000 is usually the case.
I would add though that I think there's a company, I think it's KPMG that does a online study. It's totally vetted and everything. I think they only charge $400, so that's the lowest I've seen so far.
Yeah, so the companies that we work with, this definitely does an on-site visit, and they, as part of their study, they agree to defend you in an audit as well if it comes up. But they go out, they literally tour the property, they take pictures. It's all documented in a nice report from a physical on-site visit, and so it's really bulletproof for an audit. And so I recommend working with a company that will actually go out and tour the property. I think that's the best case to just have some backup in case you are audited. So one of the nice things is with the Tax Cuts and Jobs Act of 2017, there was put into place a mechanism called bonus depreciation. And the bonus depreciation allows you to take the portion of the asset that is considered a 5-year asset, 7-year, 15-year, anything less than 20 years, and fully expense that in the first year in which you do your cost segregation study. So your 5-year assets, instead of depreciating them over 5 years, you get to depreciate those 5-year assets in the first year that you do the study. And this is going to continue through the end of 2022 and then be ratcheted down from there, as you can see. And so when we take a look at that same $1.2 million assisted living home that was sold, if we do that cost segregation study with the super bonus depreciation, we're actually creating $318,000 of depreciation in the first year that you do the study. And so on this example, it's a little bit over 25% of the purchase price we're able to write off in depreciation. That generates $127,000 of tax savings. So great tool with a lot of nice benefit to be able to realize. And so if this is something that might be of interest to you, let us know. We're happy to do a little analysis and show you how that might benefit. Generally, what our third-party partner needs is the month and year acquired, the cost of the property and the address, and then we can do a little study for you and see how that would benefit you. So this is our contact info on the screen. Royd and I are happy to help you. And I will just say our company, SVN Commercial Real Estate, we're a national company. So we do have offices in Portland, in the Sacramento area, the San Francisco Bay Area. So if you'd like to be linked up with one of our partners in your particular city outside of Phoenix, don't hesitate to reach out to us and we'll put you in touch with the right person to help you for whatever your needs are. And we're definitely happy to give advice and have a consultation call with you, whether it's a phone call or a Zoom call or whatever it is. Reach out to us. We're here to help, and we appreciate being able to talk to all of you guys today. And thank you, Daniel.
All right. Go ahead.
Yeah, any other questions? We're happy to answer them now.
I think one of the key questions I have is, as a single family or a small multifamily investor, how to make that jump between buying those types of properties all the way up to apartment level. That's the tricky one.
Yeah, I think we've certainly helped a handful of clients over the years to make the leap. And generally, if you have a handful of homes and you're wanting to get into multifamily, what we usually recommend is selling the single family homes, doing a 1031 exchange, put the sales proceeds from that into an exchange. And then with those proceeds, we can go out and buy a small apartment building. And so that might be a fourplex for someone. It could be a 5 to 12 unit property. Whatever it is, we'll do. We recommend what we think is best for our client and give advice and help them make the best decision for their goals. Everybody's different. So with different investment goals and things, we'll recommend what we think is best. But generally what it is it's selling your smaller properties, putting the money into a 1031 exchange and using that money to go buy a bigger asset and essentially grow your snowball. And that's how it kind of works is your asset value increases, sell that, take that money and accompany it with a loan from the bank and going out and buying a bigger property that can make sense. Any other questions, Daniel?
We have one question about this person is saying, in my experience, a lot of sponsors don't provide the benefit of cost segregation depreciation to their LP investors. Can you recommend a resource where investors can find sponsors that pass along these benefits to their investors?
Yes, please send me an email and I'd be happy to put you in touch with sponsors that do deals where they're absolutely taking advantage of cost segregation. I think it behooves anyone to do this on behalf of their investors and to offer the depreciation write-off, because essentially a good investment while it's performing shouldn't cost you any taxes if they're doing this depreciation right. You should get a big benefit from that.
I would add to that as well. During your investor presentation or whatever the disclosure is to the investor, the depreciation and how it's allocated should be part of that conversation. So when you're researching, a particular investment, depreciation should be a question you ask them.
Right. Yeah, that should be a pro rata on the K1. It should come back to everybody on the K1, so you can take advantage of that. Any other questions?
Doesn't look like there is.
Great.
All right.
Well, thanks for having us, Daniel.
Yeah, we'll end a little bit early. Could everybody take themselves off mute and thank Carrick and Reyen?
Thank you.
Thank you.
Thank you.
Thank you.
Thank you,
guys.
Thank you, everybody. Have a great weekend.
Thank you.
Thanks much.
Thank you.
Thank you.
Thank you a lot. Thank you a lot.
Thank you all. Bye.
All right. Thanks, Daniel.
Thanks, Daniel.
Yep. Have a great weekend, everybody. And also make sure to check out our real estate investing for professionals group, which is external to this particular group at Intel. All right. Thank you, everyone. Bye.
Have a good weekend.
Thank you.
You.